Okay, so like we're always hearing about, the economy up, down, sideways, you name it.
Yeah, exactly.
But today, something came out that I think is a pretty big deal, and it kind of like gets to the heart of how we're all feeling, about the economy.
Yeah, it really does.
And, potentially our own personal finances.
Right.
So we're going to do a deep dive into this new report that just came out today.
Yeah, brilliant.
April 11th, 2025.
Hot off the presses.
Yeah. And it paints a pretty, kind of dramatic picture of where things are headed.
It really does.
So the report we're talking about is the University of Michigan's Consumer Sentiment Index.
Right.
And we've got that thanks to the reporting by Chris Lehnes.
Yeah.
So big shout out to Chris.
Thanks.
So, this index basically, it surveys people.
Yeah, so there's a whole bunch of people.
And it asks them, how are you feeling about your own personal finances? How are you feeling about the economy in general?
Mm-hmm.
And, is now a good time to make, big purchases like a car?
Right. Should I buy a house? Should I finally spring for that new TV I've had my eye on?
Exactly.
Like that.
It's a pretty good gauge of kind of the overall, optimism or pessimism.
Right. We're feeling out there.
Yeah, exactly.
It's the national mood ring.
Yeah, there you go.
If you will.
I like that.
The economic mood ring.
So the big headline from this latest release is that it went down.
It went down.
Big time.
Yeah, it really did.
Consumer sentiment really took a hit.
It took a tumble for sure.
So what we're going to try to unpack in this deep dive is, why this happened.
Mm-hmm.
Like, why did it happen so suddenly?
Yeah.
And what does it mean for the economy? And what does it mean for you, the listener?
Right. What does it mean for your pocketbook?
Exactly.
How's this going to affect your life?
So let's just jump right into it.
Yeah, let's dive in.
So a big number is 62.5 for April.
Okay.
Now, to give you some context, in March, it was 76.7.
That's a pretty big drop.
Yeah, it's a huge drop.
In just a month.
Yeah, it's 1 month.
It's a big deal.
And Chris Lehnes, in his reporting, called it one of the steepest monthly declines in recent years.
Oh, wow. Yeah, that's saying something.
So yeah, it's like, whoa, hold on a second. What's going on here?
Yeah, so let's unpack that a little bit. A drop like that, it's not just like, oh, it's a little statistical blip. It's something's happening.
Yeah, something's going on.
And the report really points out, even though, we have seen inflation cool off a little bit from like its crazy peak.
Yeah, like it's not as bad as it was.
Right. But it's still, prices for all the stuff you need, food, gas.
Especially housing.
Especially housing.
It's all still really high.
Oh, yeah. I mean, you go to the grocery store and you're like, what is happening?
Yeah, it's like, ouch.
So that's got to be, playing on people's minds.
Right. And we've been dealing with these higher prices for a while now.
Yeah, it's been a minute.
And, it seems like it's starting to really like eat away at people's ability to just like live their lives.
Their purchasing power.
Yeah.
Like their money isn't going as far.
No.
And it's like, how much longer can we do this?
So here's where it gets interesting.
Okay, I'm intrigued.
There's starting to be a shift in what people are actually worried about.
Oh, really?
Yeah. And this is where we go to the experts.
Okay, let's hear it.
So Joanne Parker, she's a senior economist over at Market View Analytics.
Okay, I know Market View. Yeah, they do good work.
Yeah, they're great.
They really know their stuff.
And she specializes in consumer behavior.
Okay, so she really understands, like, what makes us tick when it comes to spending money.
Exactly.
Interesting.
So Parker says, and I quote, "We're seeing a shift from primarily inflation-related anxieties to broader fears about job security and an overall economic slowdown."
So it's less about the day-to-day pinch of high prices.
Right.
And more about, like, this bigger looming fear of, like, what if I lose my job? What if the whole economy tanks? That's pretty unsettling.
Yeah, it's like a whole different level of anxiety.
Right, because inflation you can kind of deal with, like, okay, I'll cut back on this. I'll find a cheaper alternative for that. But if you lose your job, that's a whole other ball game.
Yeah, it's like survival mode.
Right, exactly.
So what do you think about this shift?
Well, I mean, it makes sense, right?
Yeah.
Like if you start hearing everywhere that a recession is coming.
Right.
And you see, the Fed raising interest rates.
Yeah, they're trying to slow things down.
Right, and all this stuff is in the news, and it's got to get in your head.
Yeah, it's like a self-fulfilling prophecy almost.
Almost like if we all believe it's going to happen, maybe it will.
Right, and this kind of leads into that whole question of recession.
Yeah, is a recession actually coming? That's the million-dollar question.
Right, and the report even mentions that the Fed might keep interest rates high to try to, combat inflation.
Right, because that's their main tool to try to get prices under control. But it's a tricky balance.
Yeah, because if they raise rates too much, it could trigger a recession.
Yeah, exactly. Too much of a good thing can be a bad thing.
Yeah, so where do the experts stand on this?
Well, there's a range of opinions, of course.
Mm-hmm.
But one economist, Lisa Trent from Beacon Economics.
Okay. Yeah, Beacon's another reputable group.
And they're good.
Solid.
So she says that while the data doesn't scream immediate crash,
Okay, so we're not all going to wake up tomorrow and be like, oh my God.
right, no breadlines just yet. But she does say there's definitely a growing sense of unease.
Mm-hmm.
Like people are feeling less secure about the future.
Right.
So it's less about an imminent collapse and more about just this feeling that things might be heading in the wrong direction.
Yeah, like a gut feeling.
Right, like that pit of your stomach feeling.
But it's not just a gut feeling though, right?
No, there are some actual economic indicators that are backing up this feeling of unease.
Okay, like what?
Well, for one thing, business investment is softening.
Okay, so that means companies are like, I don't know if we should be expanding right now.
Right, they're being more cautious, they're holding back a little bit.
Okay.
And then consumer spending, which is, the engine of the economy.
Yeah, we buy stuff. That's what keeps things going.
Right. But even that's starting to slow down.
Oh, really?
Yeah, it's still growing,
Yeah.
but not as fast as it was.
Okay, so that's not a good sign.
Not great.
Mm.
And on top of that, we're hearing from some major retailers that they're not feeling as optimistic about the future.
So they're like battening down the hatches.
Pretty much.
Mm.
They're expecting that people might not be buying as much stuff in the coming months.
Okay.
So they're being more cautious with their own inventory and planning.
So things are not looking super rosy.
No, not exactly.
And then there's this thing called the inverted yield curve.
Right, the dreaded inverted yield curve.
Yeah, and historically that's been like a pretty reliable, not perfect, but pretty reliable indicator of a recession.
Yeah, it's happened before most recessions.
So can you just quickly explain what that is for people who don't know?
Sure. So basically, usually when you lend money for a longer period of time, you expect a higher return, right? Because there's more risk involved.
Makes sense.
So that's called the yield.
Okay.
And typically the yield on a long-term bond, like a 10-year treasury bond, is higher than the yield on a short-term bond, like a 2-year treasury bond.
Right.
But when the yield curve inverts, it means that short-term bonds are actually paying a higher yield than long-term bonds.
Okay.
And that's weird because it suggests that investors are more worried about the short term
Interesting.
than the long term. They think something bad might happen soon.
Oh.
And that could cause the Fed to lower interest rates in the future,
I see.
which would make those long-term bonds less valuable.
So it's like the market's way of saying, we're a little nervous here.
Exactly.
Okay, so all this, high-level economic stuff is interesting, but let's bring it down to the average person.
Right. How does this actually affect people's lives?
Yeah, so how does this drop in sentiment actually show up in people's finances?
Well, the report paints a pretty sobering picture. The first thing that jumps out is credit card debt.
Oh, yeah, I've heard that's been going up.
Yeah, it's at record highs.
Wow.
And that tells us that a lot of people are having to rely on credit cards just to cover their basic expenses.
Dude, they're going into debt just to buy groceries and stuff.
Yeah, it's a tough situation.
And then on top of that, savings rates are way down.
Yeah, compared to before the pandemic.
So people don't have as much of a cushion.
Right, exactly. Like if something unexpected happens, they don't have as much money set aside to deal with it.
And even though wages have gone up for some people, in a lot of cases it hasn't been enough to keep up with the cost of living.
Yeah, especially for things like rent and groceries.
So people are basically falling behind.
Yeah, and that's got to be incredibly stressful.
Absolutely. And maybe the most telling thing is that a lot of consumers now think their financial situation is going to get worse in the next year.
Oh, wow. So they're not optimistic about the future.
No, and this is a big change from even a few months ago when things were starting to look a little bit better.
So the mood has definitely shifted.
Yeah, big time.
It's gone from cautious optimism to what's next?
So we've got this big drop in sentiment.
Mm-hmm.
People are worried about a recession.
Right.
And they're feeling the squeeze in their own finances.
Yeah.
So how did the markets react to all this?
Well, as you might expect, the stock market didn't love it.
Yeah.
Both the S&P 500 and the NASDAQ dropped more than 1% in morning trading.
Oh.
Which makes sense, right?
Yeah.
Because if consumers are feeling less confident, they're probably going to spend less money.
Right.
And that means lower profits for companies.
So investors are like, oh, time to sell.
Pretty much.
But what about bonds?
Ah, the bond market.
Yeah, the report said that bond yields went down.
Yeah, that's interesting because it kind of goes against what you'd expect.
Okay.
Like usually when the stock market goes down, bond yields go up.
Right.
Because investors are looking for safer places to put their money. But in this case, bond yields went down, which suggests that investors are starting to think that the Fed might have to change course.
Oh, interesting.
Like maybe they'll have to stop raising interest rates or even start lowering them to try to stimulate the economy.
Okay.
And when interest rates go down, bond yields go down too.
So it's like the bond market is saying, hey, Fed, maybe you need to chill out a little bit.
Yeah, basically.
Okay, so this sentiment data is not just some abstract number.
No, it has real-world implications.
Yeah, it actually affects how the markets behave.
Absolutely.
And it really highlights how important consumer sentiment is to the whole economy.
Right, because consumers are the ones who drive the economy.
Yeah, we're the ones buying stuff.
Exactly. Consumer spending is like 2/3 of the entire U.S. economy.
Wow, that's a lot.
Yeah. So when consumers are feeling good, they spend more money, businesses do well, they hire more people, everybody wins.
But when consumers are feeling bad.
Yeah, then the whole thing can kind of spiral downwards.
So it's like a delicate balance.
It really is.
And it seems like policymakers are in a tough spot right now.
Oh, yeah, they're walking a tightrope.
Yeah, because they're trying to fight inflation, but they don't want to cause a recession.
It's a tough job.
And Joanne Parker, she said something in the report that I thought was really interesting.
Oh, what was that?
She said, if the public loses confidence in the economy, that sentiment alone can become a self-fulfilling prophecy.
Oh, yeah. It's
like if we all believe something bad is going to happen, then we might actually make it happen.
Right, because we'll start acting in ways that make it more likely.
Exactly.
Like if everybody's worried about losing their job, they might stop spending money.
Right.
And then businesses start to suffer.
Yeah, and they might actually have to lay people off.
And then it becomes a vicious cycle.
Yeah, so it's like our own fear can actually make things worse.
It's a powerful force.
So let's wrap this up.
Okay.
What's the big takeaway here?
Well, the bottom line is consumer sentiment has taken a nosedive. People are increasingly worried about a recession. And they're feeling the pressure in their own finances.
Yeah, things are getting tight.
And this isn't just some random statistic. It's
Right.
a signal that the economy might be heading for some turbulence.
So buckle up.
Yeah, batten down the hatches.
So here's a final thought for you to chew on.
Okay, hit me.
If consumer sentiment can actually affect the economy, like we were just talking about,
Right.
then how might this widespread anxiety that we're seeing in this new data,
Yeah,
how might that shape the economy in the coming months?
that's a good question.
Yeah, it's something to think about.
It really is.
Because it might not matter what the actual economic data says.
Right?
If everyone believes a recession is coming.
Then it might as well be here.
Yeah, so stay tuned.
Absolutely.
We'll keep you updated.
As always,
Until next time.
take care.
Bye.